Welcome to today's explainer of the IRS source codes and legal precedents surrounding worker classification. Look, if you're a small business owner, an operator, or a founder, you already know the massive economic temptations staring you down every single time you bring on a new worker. Do you classify them as a W-2 employee, or do you bring them on as a 1099 independent contractor? The financial and administrative incentives to lean toward a 1099 are frankly incredibly strong. But getting it wrong, it can completely upend your business. So today we're cutting through the noise and looking strictly at the facts to help you survive the worker classification maze. Okay, let's dive into this. Here is our roadmap for today's explainer. We'll start with the worker classification trap and the federal rules for measuring control. Then we'll hit state variance, audit triggers, and the financial impact. Finally, we'll cover the Section 530 safe harbor and how to protect your business.
Section 1, the worker classification trap.
This is arguably one of the most litigated areas in all of small business tax. And looking at these two columns brilliantly illustrates exactly why it's such a trap. I mean, look at the economic reality here. As a founder, that W-2 column represents a really heavy administrative burden. You've got employer-side payroll taxes, workers' comp premiums, unemployment insurance, and benefits administration. Contrast that with the 1099 column. For a contractor, there's no employer-side tax, no workers' comp, no benefits to manage. It is so easy to see why business owners are deeply tempted by the ease of 1099 contractors. But listen, you cannot simply choose a column just because it's your preference. Section 2, federal rules, measuring control. Because here's the thing, classification is a fact-based legal determination. It is entirely out of your hands as a mere business preference. To really understand the federal framework, we have to look directly at the code. Internal Revenue Code Section 3401 defines wages and employee for federal income tax withholding. And this statutory framework relies on a very specific common law test, control. It basically asks whether the principal, that's you, the business, has the right to control not just the results of the work, but the means and manner by which that work is actually performed. So, the crucial point is this. How does the IRS actually prove if you have that control? If you're sitting there right now thinking, well, hey, I don't micromanage them, so they must be a 1099, you might want to brace yourself for what the IRS actually looks at. Historically, the IRS used this massive 20-factor test, but they've actually consolidated that into 3 broad categories of evidence. First up, behavioral control. Do you dictate what they do and exactly how they do it? Second, financial control. Can this person incur a profit or loss? If they literally can't lose money on a bad job, the IRS usually sees an employee. And third, the type of relationship. Is the engagement permanent or is it project-based? Do you offer vacation pay? No single factor decides the outcome here. The IRS looks at the totality of these facts. It's like a giant puzzle.
Section 3, state variant and audit triggers.
Now, here is the really scary part. Surviving that federal test doesn't mean you are entirely in the clear. A growing number of states, including California and Massachusetts, use a highly aggressive standard called the ABC test for state-level employment matters. To classify someone as a contractor, you must satisfy all 3 of these prongs. Prong A, they are free from your control. Prong B, they perform work outside the usual course of your business. And prong C, they have an independently established trade. Prong B is usually the absolute hardest hurdle for a business to clear. Think about it. If you run a delivery business and you hire a quote-unquote 1099 delivery driver, you instantly fail prong B because driving is the very core of your business. So how do businesses actually get caught in this trap? Usually it's through the most routine actions. Look at these common audit triggers. Say a 1099 worker gets let go and files for unemployment insurance. Boom, that triggers a state-level determination which often gets shared right back with the IRS. Or a contractor gets hurt and files a workers' comp claim. Or perhaps, and this is a big one, you issue both 1099s and W-2s to people doing the exact same job in your company. These routine, everyday events can instantly trigger a multi-agency audit.
Section 4, financial consequences.
If the IRS, the state, or the Department of Labor reclassifies your worker, the financial fallout is compounding and severe. We aren't going to make specific dollar savings or penalty claims here because it scales with your payroll, but structurally, the liabilities are massive. You could be liable for back federal employment taxes, including the employee's share if you didn't collect it. You're looking at retroactive federal and state unemployment taxes, retroactive workers' comp premiums, and on the Department of Labor side, potential back wages, overtime, and liquidated damages under the Fair Labor Standards Act. Section 5. Section 530, Safe Harbor.
Now, what's really interesting about this slide is the potential for relief.
There is actually a statutory escape valve for businesses that have consistently misclassified workers in good faith. It's called Section 530 of the Revenue Act of 1978. Notice I didn't say Internal Revenue Code. This is actually a standalone statute outside the main IRC. It provides a specific mechanism for relief strictly from federal employment tax liability. But qualifying for this federal relief requires meeting 3 very strict mandatory conditions. It's a step-by-step process. 1. Reasonable basis. You must have based your classification on judicial precedent, a past IRS audit, or long-standing industry practice. 2. Substantive consistency. You must have consistently treated this worker and all similarly situated workers as contractors. And 3. Reporting consistency. You absolutely must have timely filed all your Forms 1099. If you miss even one of these, the harbor vanishes. And remember, this doesn't protect you from state-level or Department of Labor liabilities at all.
Section 6. Protecting your small business. Let's talk about proactive structural defense. First, you need to watch out for dangerous edge cases codified in the tax law. For instance, certain workers, like full-time life insurance salespeople, are actually considered statutory employees under IRC Section 3121D3. And here's a massive pitfall to look out for: corporate officers. Under IRC Section 3121D1, an officer who renders services is treated as an employee. Paying a corporate officer purely via a 1099 is a classic, easily caught misclassification. Also, don't forget IRC Section 3406. If a contractor doesn't give you a W-9, you are legally required to do backup withholding on their payments.
If you take just one thing away from this explainer today, let it be this core philosophy. The label on your contract absolutely does not matter. The facts of the relationship do. One of the biggest myths among founders is that just having a worker sign a piece of paper that says independent contractor magically protects the business. No way, it doesn't. If you require them to work set hours at your location using your equipment, the IRS will look right past that piece of paper.
Proper worker classification is not about clever tax planning. It is about structural design. You have to design the engagement so the worker is genuinely operating an independent business. They need separate clients, their own tools, and a project-based scope. Because the rules vary so widely between federal common law and those aggressive state tests, this is my firm non-negotiable call to action for you. Consult your tax professional before bringing on any worker whose classification is unclear.
So I want to leave you with this final provocative thought to reflect on as you look at your own operations. Look closely at the people building your business alongside you. Does your paperwork truly match your daily reality? Because when that audit letter comes, reality is literally the only thing the agencies are going to care about. Thanks for joining me on today's explainer of these critical regulations, and I highly encourage you to go audit your own business practices today. Catch you next time.